It's Monday, the 16th of March, 2026, and this is an update for the Albert E. Sharp short-dated low-coupon gilt model. Now, following the US and Israeli strikes on Iran 2 weeks ago, we've seen a very sharp sell-off in government bonds across the developed markets, and the UK has probably fared a little worse than others. And in this short video, I'm going to explain why I'm not too concerned for the strategy, and more to the point, why I think that this will prove to be an incredibly attractive buying opportunity. But there is some urgency to act now because this moment could be fleeting. My name's James Crocker and I look after the model portfolio service here at Albert E. Sharp. And one of our more specialised strategies is the short-dated low-coupon gilt model. A bit of a mouthful, but the concept is fairly straightforward. It is to provide a low-risk alternative to bank deposits, and importantly, one that is almost entirely tax-free. Now, remember, there is no capital gains tax on gilts, which are UK government bonds. There is income tax on the coupon, effectively the interest that's earned. So our strategy is to build a portfolio of low coupon gilts, to manage it over time, extend its life, maximise the yield, and within reason, maximise returns. We started the model back in October 23, and at that time base rates were 5.25%. Today they're down to 3.75%. Now, at the time, we were working on the basis that the annual return would be vary somewhere around the portfolio yield to maturity, which at the time was 4.7%. Since then, interest rates have fallen, so have yields, and through most of 2025 and into the early part of this year, the portfolio yield was trending lower, almost touching 3.5% by the end of February. Now, over the period, we've enjoyed very stable returns, a very stable return profile as the chart shows. And that's largely due to the short-dated nature of the gilts that have tended to be under 2 years in maturity for most of the time. But at the end of February, we saw one of the sharpest move lower in gilt prices in recent times following the onset of the conflict in Iran. The reason? Well, rising oil prices means higher inflation, and higher inflation means that interest rates are less likely to be cut by central banks, or so the orthodoxy goes. And as we can see, this gilt that we hold in our portfolio, it matures on the 31st of January 2028. It's down a full percentage point since the crisis began. Now, it's not a huge amount in the grand scheme of things, but what it means is that yield has now risen from 3.3% to over 3.9% in a matter of days, and in that sense offers a return almost 20% higher than it just did 2 weeks ago. These types of swing in such a short space of time are very rare. Now, the bond market is all about expectations. Interest rates don't need to change for bond prices to move, and the Iran crisis has had a dramatic effect, as shown in this chart from Bloomberg. And it reflects probabilities. Now, the calculations are quite complex, but the message is very clear. The market has now gone from pricing in 2 quarter-point cuts in interest rates in the UK by this time next year, which was immediately before the crisis 2 weeks ago, to now suggesting that there will be 1 quarter-point rise over the next 12 months. According to the market, interest rates are going up in the UK. Now, for our gilt model, falling interest rate expectations are good news. And as we've seen over the last 2 weeks, rising expectations are bad news. But the real question is, where do we go from here? Well, I think, quite frankly, the market has got it all wrong. It's overreacted. So, due to higher oil prices, a serious brake on economic growth, the members of the Bank of England Monetary Policy Committee will, over the next 12 months, vote to raise interest rates in order to curb inflation. Really? Well, my view is that the market has got this wrong. It's overreacted. And I maintain that the economic data, such as GDP growth and unemployment, is only likely to get worse. Just this Friday, we received news here in the UK of zero month-on-month GDP growth compared to expectations close to 0.2%. Higher oil prices are only going to make the situation worse. Sooner or later, there will be political pressure to cut rates. Now, I argue that inflation will suddenly fall down the list of priorities, and when unemployment numbers start to rise, we will indeed see those cuts come through, in which case gilt prices snap back up, yields fall back to where they were. So the opportunity to get annual returns locked in close to 4% now is, in my view, very attractive in and of itself. But that doesn't actually mean that returns couldn't be more than that over the next 12 months. They could be front loaded, because I see a scenario you could actually see a return close to 5% over the next 12 months if the market starts to straighten out a little. Now, of course, there are no guarantees. I can't promise that we won't see a huge policy mistake, but it also feels that the downside for gilts, certainly at the short end, is pretty limited. The gilt model is just one way of playing this. Some clients are happy just buying one gilt, especially if it matches a future liability with a known date. But there are also now several structured products that look very, very interesting at the moment. They involve more risk, but we're talking potential returns close to 15% and possibly higher than that, even in the short term. So if you'd like to know more, please, by all means, get in touch. Now, as an aside, the numbers used in this presentation were as of the close of play on Friday. And at the time of recording, which is midway through Monday, we've actually seen a very, very slight recovery. But in my view, there remains a long way to go. So I hope you found this helpful. I hope you found it useful. Any questions, please let me know. Thank you.